I think the important thing about the dollar is time frame and degree. A lot of the media coverage this week with the threats of possible military intervention to acquire Greenland against its will, and then the backing off it. You saw some market reaction, but it was really just a one-day sell America. And everyone's saying, well, gosh, no one sold treasuries. Everything's fine. It's all hype. I'm like, no, it's not. It's time frame. What we're seeing is a slow erosion of confidence in dollar-based assets. This is something that will play out over years, not a day or a week or a month, but it's happening. We saw news this week that Sweden's largest private pension fund is reducing significantly its treasury holdings. And yes, Denmark is not a large country, but they're getting rid of their treasuries. There's more to come.
I mean, Paul, I just love it having Rebecca. And can you just see the poor soul who had 3 martinis in the city in London, goes back to their desk at a major bank, calls up on the phone and goes, sell America.
Sell America, exactly. So what does that mean for the dollar here? We had the dollar sell off early last year.
Yep.
Then it could stabilize and actually had a decent second half of the year here. Is the dollar still at risk, do you think?
Modest risk this year. So, there are a lot of factors that come together that drive currency markets. Part of it is cross-border capital and trade flows. Part of it is expectations for interest rates, so the relative yield of a currency. What helped the dollar in part in the second half of last year, we didn't see as much hedging action. So foreign or U.S. investors hedging out dollar risk. And then we also saw a reduction in expectations for Fed rate cuts, i.e. relatively higher rates, and that also gave a support to the dollar. This year, given how strong the U.S. economy is at a high level and given sticky inflation, which you talked about earlier this morning, it's going to be hard for the Federal Reserve to cut much unless something drastic changes. So that is going to prevent the dollar from weakening a lot. The dollar hedging, the diversification, like I said, this is kind of a slow drip, drip, drip. This isn't a sudden flood. So I wouldn't be shocked to see a stable or maybe slightly lower dollar this year.
Well, given that backdrop, the global geopolitical backdrop, I guess it's no surprise that we've seen gold been ripping like crazy. Is that still kind of the play?
Yeah, so to me, that's the most obvious reflection of the diversification trade that's taking place. We know some of it is investors, and those could be speculative investors as well. But underlying that, we continue to see central bank demand. Central banks diversifying slowly but surely out of the U.S., looking for other liquid assets. You talked to my good friend Mark Sobel at OMFIF, the World Gold Council. Both of them do really good surveys of central banks every year, asking them, what do you intend to do going forward? And the data shows that they're going to keep buying gold.
Across this nation, Rebecca Patterson with us, and we continue. She's, of course, a senior fellow of the Council on Foreign Relations. Good morning, the way you listen to us across America. Good morning, particularly on the Pacific Rim, Spotify, which we find is unusually popular over on Asia and to India as well. On YouTube, subscribe and listen and watch on YouTube with Bloomberg Podcast. It was not expected a meeting of the President of the United States with Mr. Zelensky of Ukraine, clearly off the radar given yesterday's festivities. Mr. Zelensky now speaking at the meetings of the World Economic Forum in Davos. Our team there will give you all that coverage. We'll look for the headlines here and bring them to you when we can. I look at your Council on Foreign Relations. I mean, Froman hasn't slept in 6 days. It's nuts. Everyone's publishing. I know you're going to publish and give us a head start on that. But I look at back-to-back in the Foreign Affairs magazine, Elizabeth Economy on the international relations of the Arctic Ocean, and then you followed up with your senior fellow on China with all that's going on. In the frenzy at CFR, what are you focused on most? What does Rebecca Patterson study?
I always look at the intersection of geopolitics, the economy, and financial markets because they all influence each other. One of the things I'm looking at now ahead of the Supreme Court decision about U.S. tariffs is if we reduce the tariffs, take them off, shift them around, how does that translate into the affordability narrative in the United States? If tariffs are removed, do we actually see any price change that benefits U.S. consumers? How does that play out in the midterm election? So again, it's looking at all these connections. So that is a piece of work I'm working on right now because I think we should get the Supreme Court decision fairly shortly. So that's one. I think the other one I'm trying to spend time on is the Federal Reserve. So we know we're going to get an announcement probably in the next week or so with the next nominee. But none of us ever had to think about the legal intricacies of the Fed before. Now I'm trying to understand things like, could you see not only $200 billion buying of mortgage-backed securities, could you see $1 trillion of mortgage-backed securities?
Paul's got 8 questions. Let me be rude and interrupt once more. At Bessemer Trust, ages ago, you don't go to cash. I mean, with all the cacophony you just mentioned, how do you handle this news at CFR and where else? Zelensky speaking right now to a packed room. How do you do it and not go to cash?
Well, I think the big takeaway for me is that while treasuries, U.S. government bonds still act as a diversifier in a portfolio, you can't expect them to work as effectively as they have for the last several decades. So when you diversify a portfolio, you have to think about it differently. That is part of the support for gold prices, which is extraordinary. It's part of why we see people going into alternatives more, different types of alternative assets. And I think it's part of why, again, so far this year, we're seeing foreign markets outperforming the U.S. So it's asset diversification, geographic diversification. But you're right, Tom, getting out of the markets, given that risk assets outperform diversifying assets 8 years out of 10, because the economy is growing 8 years out of 10. So to get out to react to the geopolitical headlines, you're doing yourself a disservice.
And Paul, as you know, you got to get back in. I mean, I was in cash, but I took the leverage away and I went further to cash 2-3 days ago.
Fine, no problem.
I'm hammered. I missed this.
I mean, even professional investors, the smartest ones in the world, timing when to get in and out is a fool's errand. That's why you stay in the market. You just make tactical shifts on the margin.
All the news this week coming out of Davos, coming out of Greenland, we kind of forgot about Japan had a little bit of a problem in their bond market earlier this week. That spooked people big time earlier in the week.
Yes.
Was that just a technical thing? Should we not worry about it? Is there any contagion issue there?
Yes. Okay. So, yes, you should worry about it. Yes, there is contagion. I'm talking about U.S. Treasuries and are we going to have enough buyers to meet the amount of supply we have to issue to pay for our deficits? But it's important to remember over the last 20 or so years, global bond markets have gotten much more integrated. People own global bonds, not just their own country's bonds today. And that means something that happens in Japan or France or the UK can and will affect the U.S. Treasury market also.
Okay.
So we do need to care about Japan, what the Bank of Japan does at its next meeting, which I believe is tonight, right? And then, of course, Prime Minister Takaichi, when she has this snap election, do we see additional stimulus after that? How does that make people think about the fiscal dynamics?
So, again, I come back to I have to buy U.S. Treasuries. Buy Treasuries in gold.
No. Look, I'm not saying dump all your Treasuries by any stretch, but you want to think more diversified. It's been fascinating to me to see that you are seeing institutional investors looking at more fiscally sound bond markets today. So countries that don't have those big debt difficulties looking ahead.
So you load the boat in Germany? Is that what I'm hearing here?
I mean, some of the European bond markets are attractive. Canada, Australia, relatively better. Norway, Singapore. The problem is these markets don't have as much liquidity. So that's only so far it can take you. But you do want to have a global basket of bonds. And emerging markets. EM is the new DM. So emerging market fiscal dynamics today are much better than they've been in general. I'm not talking about every country for a long time.